This conference will now be recorded.
Okay, so good morning, everybody. I would like to call this June 26th, 2020 meeting of the Connecticut Green Bank Board of Directors to order. I think it's about 9:04 a.m. and we have a quorum. Are there any public comments? Hearing none. Before we get started with our business items, I wanted to take a moment to introduce our newest board member. So some folks have met him, but Steve Meyer, we're very excited to have him. He's replacing Bettina Brown Eyes, whom we love as well. So we know he's bringing real assets to the experience. Steve he joined the Treasury, the state Treasury, in December as Assistant Treasurer, Cash Management, and Senior Principal Investment Officer. So he's going to be very busy. He comes to us, he was with State Street Global Advisors, where he was Executive Vice President and CIO of Global Fixed Income Currency and Cash Management. Earned his MBA from Indiana University and a BBA from Hofstra University, and holds an advanced certificate in investment management from the London Business School. He's a money guy, and he's got incredible credentials. And Steve, I see in your bio that you call yourself Steve, so I'm guessing that's the preferred way you want to be addressed. And I'm wondering if you want to say a few words.
Oh, thank you, Lonnie, for that kind welcome and introduction. No, Steve, I go by Steve. I'll also answer to Steven if I'm in trouble. But no, I'm actually very excited to join the board. I'm really been working very closely with Bettina to come up to speed on the items so that I can start adding value, hopefully in short order. But again, I hope to get to meet you and everyone on the board in person at some point when we get to more normal times. But in the meantime, again, thank you for that warm welcome, and I'm really very, very happy to be here.
Well, we're delighted to have you join us.
Thank you.
Okay, turning to our first item of business, the April 24th minutes. Let's get those out of the way. Are there any additions or corrections? Okay, I hear none. Do we hear a motion to approve those minutes?
This is John Harity, so moved.
This is Brenda, I second.
Great. All in favor?
Aye.
Aye.
Aye. Aye.
Aye.
Opposed? Okay. All right, those minutes are approved. And we're now going to turn to it's a presentation. I'm looking at the Inclusive Prosperity Capital Progress Targets, and we always turn to Bert to handle these presentations. So, Bert?
Good morning. I think this will be the update on COVID-19 restructurings and write-offs. Is that correct, Brian?
That's right. Yeah, please go. And just so the board knows, we provided in the consent the memo on the update for IPC through Q3 of fiscal year 2020. You'll get a full briefing next month when we look back at FY 2020. They're doing very good on the delivering progress to target. So that material's in the board meeting. But okay, Bert, the COVID-19 restructurings and write-offs.
Yeah, and I just wanted to say before Bert speaks that the team has been working so hard on this. I mean, clearly we're in a new experience that no one has had before. So kudos out of the box, because I know it's been nonstop. So Bert Hunter.
Okay, thanks, Madam Chair. Yes, we mentioned to the board that we would be reporting out at board meetings on as we move through COVID-19, and any requested requests for modifications from our consumer homeowner portfolio, as well as our commercial and industrial portfolio. Fortunately, the requests have been rather light for us. We think that at least so far, and perhaps this has to do with the particular cohort of homeowners that we have in our portfolio, as well as perhaps just the fact that maybe the full effect of the slowdown has not yet settled in. There have been a number of stimulus packages from Washington that are still in effect. So we are actively monitoring the situation. But so far we've been rather fortunate, as you see on the screen, with our Smart E-loans, and these are loans which are not in our portfolio, but which we stand behind with our loan loss reserve in a second loss position. 45 loans are in deferral or forbearance across 4 lenders, 3,752 active loans, so about 1% of active loans. The lenders have generally been offering up to 90-day deferrals, although some customers were just looking for 30 days in the expectation that they would be back to work shortly. Capital for Change, which is a CDFI community development financial institution which caters to underserved markets, recently requested to extend 90-day deferrals up to 180 days, which the Green Bank and IPC supported, given still out of work borrowers in their portfolio. In CT Solar Lease, very few, less than 0.5%, only 5 leases. CT Solar Loan, absolutely no requests for deferral at this time. And Posigen, there's been 1 charge off in their portfolio, Connecticut portfolio, but it was not COVID-19 related. And generally for the Posigen portfolio, they have been doing quite well on their collections. Multifamily loans, next slide, please. There have been no restructurings or write-offs for the Lime or pre-development loans. In CPACE, we have had a number of restructuring requests that we are in the process of processing. 4 have been approved. The outstanding balance of restructurings is $8 million at this time. And that is on par with what we have been hearing for commercial and industrial loans of the banking community more generally, somewhere in the vicinity of 15 to 20% of C&I portfolios of local banking institutions, we understand, have been asked to be modified or some kind of forbearance. We are doing those restructurings with time value of money adjustment. So this is not forgiveness, this is forbearance. So the Green Bank is made whole on a time value of money basis, but there is a current cash effect as the payments are deferred for, in the case of CPACE, 6 months. So let's see, a CPACE solar PPA, there haven't been any requests so far. And we have 1 request from Canton Hydro, which will be the subject of an approval later in this meeting. And that's the report out from here, Madam Chair. Back to you.
Thank you, Bert. Our next item, we have recommendations from the board's audit, compliance, and governance and deployment committees, and it's regarding the addition of a loan loss decision framework and process for Green Bank subsidiaries. Brian Garcia.
Great. Thank you, Lonnie. So just following on Bert's report out on the loan loss decision framework and process as it applied to our COVID-19 restructurings, you might recall back in June of 2018, the board approved of a framework for Green Bank assets. We had noted in that memo that we would be coming back with a framework and process for subsidiaries. And obviously we create subsidiaries to help provide capital and financing in specific areas, specific market segments of Connecticut. We can go into some of those subsidiaries if you'd like. So we've got those two things put together, the organizational framework and the COVID-19 restructuring. What you're seeing today, or the proposal today, is to just expand the framework to subsidiaries. There's no changes to the framework. It's just we would apply the overall prior approved framework to subsidiaries. So we do have a number of them. We've built quite an asset base through our subsidiaries, having nearly $65 million in assets that are producing income for the Green Bank. We continue to make investments through our subsidiaries to support clean energy deployment and reduction of energy burdens for various end-use customers, and obviously with the expectation of getting our principal and interest back over time by making those investments. And Bert gave a really good review of a number of our different programs. The oversight with respect to our assets really comes through the deployment committee per these noted bylaws here on the slide. They have the responsibility for managing assets. In terms of process, the senior staff here is proposing a loan loss decision framework for subsidiaries. We've already had a conversation with the Audit, Compliance, and Governance Committee in May. We followed that up with the deployment committee meeting in late May. And then today we're bringing it forward to the full board of directors. There's no changes from the existing structure or framework that we use for the organization for the subsidiaries. So we would continue to follow the framework with the unique adjustment that we've got for COVID-19 related restructurings that Bert just provided an overview of. So this framework follows the same practice. We calculate impact, net present value impact of any restructuring or write-offs. Our team documents all these things. If these principal amount outstanding crosses these various thresholds, they go to the respective committees or the board. In fact, today, the virtual net metering project in Canton Hydro is a perfect example of a project where we have a principal value over $1 million. Therefore, we're bringing it to the board for review and approval. So same process that we've used before, and we're just going to apply it to our subsidiaries. So happy to take any questions, comments.
Okay, hearing none.
Brian,
do I hear a sorry. Go ahead.
Just a quick question. This is Brenda. So my biggest fear is the financial impact of COVID may mean the legislature might try to raid energy funds again. Are we planning for such a loss?
Great question, Brenda. Here's the way we look at it. What the legislature has done prior in terms of sweeping resources from Conservation and Load Management Fund and the Green Bank has been they've channeled the System Benefit Fund from the top to the general fund. Back in October of 2017, for example, the Clean Energy Fund that the Green Bank administers, they swept $14 million a year of $26 million that comes to the Green Bank. So that could potentially happen down the road, given what the state budget situation is looking like. But the Green Bank, we've developed a sustainability framework in December of 2017, whereby we've invested in a number of income producing assets. We've provided loans and leases that are generating interest income to the organization. So we called it our sustainability framework. As you'll see from the revenues coming into the organization for the upcoming fiscal year, our revenues are increasing from non-ratepayer resources. So that's part of our strategy. If we continue to make these investments, we will eventually generate interest income that covers our operating expenses. So that was like the foundation to what we were striving for. So we're heading into, as Lonnie is alluding to, a very difficult, challenging budget cycle given state budget deficits, but we are, as a result of the 2017 efforts, trying to become more resilient to those sorts of impacts on the organization.
That's great. Thank you.
I should say too, Brenda, this is Lonnie. You know, as we know, higher court has upheld a lower court decision that was okay to repurpose the money. But I think that as I was in the legislature at the time, as I recall, Brian, the Green Bank began to make it very clear that these monies were already obligated, so that there were contractual obligations, as opposed to just cash sitting around. And so I think it's really important to keep telling that story when you're talking to the Finance Committee and, you know, the various powers that be, to really show that it's not just hanging around looking for a place to go. It's already designated, and it would undermine, you know, our investment credibility.
That's right.
I agree.
Lonnie.
Thank you for that. Yeah, that's something that we've been floating around in the GC3 process, and how to prepare our pushback on that if they start talking about it again.
Well, and I think as well, I mean, we've talked about this in some of our other meetings. The things that the Green Bank are doing, this is part of our recovery. These are jobs. This is moving forward. This is our future. And, you know, and hopefully, whichever the new federal administration will be, you know, these kinds of things are going to be on the top of the to-do list as well. So I think it's really important to tell that story, because as we talk about it frequently, when you get into energy jargon, you know, most people, let alone legislators, have no clue what you're talking about. They just see money and they see programs in their municipalities and their districts that are going to go away or be impacted, and they're going to go after anything that looks like, you know, money that hasn't been contractually obligated. So I think the more we tell that story, the better off we are.
Lonnie, this is John Harity. I just wanted to add that the governor has been very strong and very vocal in his support of the Green Bank, and saying that there should not be any more sweeps. And even though I know the legislature has the ability to overrule that, it's I think that there was a kind of a reaction after the sweeps that will make it more difficult for them to go after us again.
I agree, John. Lonnie again. And Brenda, all the work you've been doing is so critical right now. When we talk about, you know, priorities, energy and environmental justice and equity, which you've been fighting for years. I mean, this has got to be at the top. And look at how COVID-19 impacted communities of color and low and middle income communities. I mean, that's a sin for us not to really, you know, do the kinds of things that we need to do to create healthier communities. And, you know, so, you know, really keep telling that story and we'll help you.
I agree 100%. Thank you.
Okay, so I think we're in the middle of asking for a motion to approve the recommendations from the Audit, Compliance, and Governance and Deployment Committees regarding the addition of a loan loss decision framework and process for Green Bank subsidiaries. Do I hear a motion?
I make a motion. This is Brenda.
Oh, great. Second?
Second, John Harity.
All in favor, or discussion? Any more discussion? All in favor?
Aye.
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 Opposed? Okay, and no abstentions. We're good? We're all on, we're all on the record. Okay, excellent. Item number 3 is we're proposing changes to the bylaws and ethics policies. It's part of our annual review, you know, when we update them and see, you know, what the challenges have been. And so Brian Farnan, Representative Farnan, is here and will present. Brian.
Just Brian. You guys are all my bosses. So I'll try to do this quickly. I know we've got a pretty packed agenda today. So this is just our attempt to kind of put in place some best practices. After there's a outside audit of the Connecticut Port Authority, and they just look at everything, and they just made a bunch of just recommendations. And when we look at those recommendations, a lot of them could apply to the Green Bank also. So we just wanted to instill them into our bylaws, and some were pretty straightforward. It's, you know, adding the purpose and function of the Green Bank, like straightforward. One of them was, you know, we have the ability to now add a treasurer to the board of directors. That was one that we can, you know, we'll have to, I think, bring back after this meeting if we adopt it and think, okay, how do we want to do that? What's the role? Obviously, you know, as a treasurer, it's kind of be at a 40,000, 50,000 foot level type of responsibilities. So we're, you know, adding that. Another one is just adding the board of directors, you know, oath requirement right into the bylaws. In the past, you know, that's something we do as practice, but it was not something that was actually included in our bylaws. And we wanted to do that. We also, another thing that we did was we changed the Budget and Operations Committee to the Budget, Operation, and Compensation Committee. This audit review said that every board or every quasi-public should have a compensation committee. And when we went and looked at our governance documents, what we found out was like, you know what, our Budget and Operations Committee already does a lot of the things that they're asking for in this compensation committee. So instead of creating a new committee, we said, let's fold in whatever we're missing, whatever small things we're missing in this recommendation into the Budget Operation Committee responsibilities. Then also we added in language about the importance of the loan loss decision framework, and we expanded the conflict of interest to include immediate family members of the board. I mean, pretty straightforward. We also added restrictions to when directors and employees leave the Green Bank. These are things that are already kind of practice. We actually just memorialized. And then we added a definition of clean energy right into the bylaws. So if there's any questions, let me know. Or I would definitely entertain a motion, whatever you prefer, or discussion.
This is John here. I had a question. Looking at the description of the Green Bank's functions, it talks about clean energy, but there's no, the phrase climate change does not appear anywhere in the bylaws. I wondered whether it ought to be there.
I mean, we could, if you look at a stated in its resolution, demand for clean energy development of technologies to support clean energy and development of the state's clean energy related economy. I mean, we could add something at the end of that sentence and to mitigate the impacts of climate change.
I mean, I personally, I think that would be helpful in defining the bank's part of the bank's role.
Okay.
This is Eric. I want to support that. Go ahead.
Okay. If there's a
Steve Meyer,
friendly,
can I ask a question? Sorry.
Sure.
This is Steve Meyer. Just a question about the. Are we confident that the lack of an independent compensation committee or one that's combined with the budget committee doesn't present conflicts of interest, and will that pass muster with the outside auditors?
I think it will. I do. I think that it's not like I think by adding that, we are including the compensation whatever things they wanted in a compensation committee, we are calling out as part of that committee. So it's not like we're watering it down. I think if we just explain from a functional standpoint, from a governance perspective, we felt that this was the best place where it should sit because of the other additional roles of that committee, so they can kind of get a full understanding of the organization. I think they'd be okay with it.
Okay.
And then maybe let me add a little bit more to that, Steve. So in general, what you'll see in the budget is the Budget and Operation Committee recommends a merit pool and a promotion pool. The merit pool is 3%, the promotion pool's 1.5%. Eric, correct me if I'm wrong. And we've got a process that we go through as a staff over the summer to do 360 reviews of staff to determine the merit pool. Any promotions of officers is done at the board level. All of that is very transparent. So I think the B&O and Compensation Committee kind of lays out the framework, and then the process is very good. And of course, all of our salary data is publicly available on the comptroller's website. So I think to Brian's point, there's a lot there process-wise. That will
already
happen.
So much overlap. It would almost be like, it would be weird to have the Compensation Committee, because the roles of the B&O committee already kind of are handling much of that. So there almost is like this synergy between the functions of what both are trying to do. So I think it would be almost disjointed not to have that as one committee.
Gotcha. Okay. Thank you.
Okay, so this is Lonnie again, do we need to amend the resolution 3 to include the climate change language?
Yeah, and
that we just discussed?
I think an amendment to the resolution to add and to mitigate the impact of climate change to the purpose of the green bank, and then I can tighten up from there.
Okay, is everybody on board with that? Okay. So let's.
Yeah.
We're good. Okay. So
Yes.
go ahead.
I agree with the change, Mrs. Binu.
Okay, anyone else?
Yeah, this is Eric. I'm not going to support that. Thank you.
Okay, so we're assuming that the amended version will contain that language, and we have, what do we have, 7?
Yes.
Okay.
We should probably go through votes of each member just so we can tally it and have it on the record to show the supermajority in the quorum.
Okay, good. So do I hear a motion to approve the amended version of item 3?
This is John Harity, so moved.
Do I hear a second?
And this is Brenda, I second.
Great. So let's do a roll call, or just chime in with your vote. So all in favor?
Aye.
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 And all opposed? Eric?
Opposed.
Okay. And any abstentions? All right. So I'm guessing that item passes. Moving on to item number 4. Proposed changes to the employee handbook. Brian, are you going to talk about that? One of the Brians?
Eric.
Oh, Eric?
Want to lead it?
Sure. Brian, can you guys hear me?
Yeah. Perfect.
Okay. So, Yeah, so every year we update our employee handbook. Typically, we do it in the fall. This year we decided to be a little bit more proactive and do this just so that we could be in line with what we're doing for COVID-19. The updates to the handbook reflect just things we typically would do to bring the handbook in line with our current operations. So updating titles, phone numbers, small details. While we try to make sure that we're maintaining a balance of being specific enough, but not too specific, so that if somebody leaves or something minor changes, that it doesn't really invalidate things, but still requires updates on a regular basis. We needed to reflect our current technology. We've upgraded our phone system, which impacts our emergency preparedness. So all of that needed to be updated. We needed to reflect current software and just current operating procedures for that. Ethics, we introduced a new broader definition of ethics, which is being used by Connecticut Innovations, just reflecting that we hold our employees accountable and expect a high level of ethical conduct. It's just to set the tone of that section of the handbook. And then finally, telecommuting and flex time. Due to COVID-19, we have full telecommuting for staff. It's been working quite well. We've updated to reflect that and to reflect our flexible time policies, just to ensure that we're enabling that for staff to use where appropriate. Questions?
Any questions? Do I hear a motion to approve?
This is Brenda, motion to approve.
Second?
Steve, second.
Harity.
Okay. All in favor?
Aye.
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 Opposed? Okay, that motion passes. Moving on to item 5. Oh yeah. So this is going to take a little bit of time. So these are the proposed fiscal year 2021 targets, budget and investments. The Budget Operations and Compensation Committee has had, I think, at least 3 meetings on these elements. And I think, Eric, are you going to lead off on the presentation?
Certainly. So thank you, Madam Chair. So we have our targets as we do every year. This year was a little bit more of a difficult process just due to the present environment in which we're operating. But we've prepared ranges of targets based off of kind of best case and worst case scenarios of what we think we can achieve this year. And we'll be presenting those in the lines of our 2 business lines, our incentive programs and our financing programs. So let's start off with the incentive programs. So this is primarily ARSA projects. We know that we are approaching the statutory max of the RCIP, so the 350 megawatt target. And so these targets are built around us achieving that sooner, or a possible extension of that if the legislature decided to take that up and extend that. We also have included in here our Solar for All, so our low to moderate income targeted incentive with Posigen and other providers. We have a new battery storage program that we're proposing. We're currently working on this with Pura. This portion of the targets is contingent upon that recovery or that approval, and would be cost recovered through Pura. And then the final item is the Smarty loan program, and this is based off of what we've seen this past year in terms of activity. We had a very good year, but this past quarter we've been impacted with COVID-19, and homeowners have been reluctant to let contractors into their homes. We're seeing some of this start to pick up. We're seeing some increase of applications in RSIP, so we are hopeful, but we're still cautious. We are proposing an interest rate buy down to juice the market for specific technologies as part of the Smart 8 for this year. Those technologies being renewable heating and cooling, so ground source and air source heat pumps, as well as electric vehicle charging infrastructure and battery storage. So all areas where we hope to further the decarbonization outside of just pure energy efficiency that we've tackled in the past. So for the incentive businesses, the incentive programs, the Connecticut Green Bank will support between $89.5 million and $153 million of investment for 3,094 to 5,646 projects that will install a capacity of between 24 and 42 megawatts of clean energy. This year, we're also bringing in, with these targets, an estimation of the air quality impacts of these activities. And so we're hoping to avoid the emission of somewhere between 18,737 tons and 32,425 tons of carbon dioxide. So, and we're proposing, one of our reasons for bringing in these new air quality impacts is we are advancing with our pilot for electrical or alternative fueled vehicle charging infrastructure, and the way that we really can equate that activity, because it doesn't really fit in with our other key performance indicators, is through the air quality impacts. So if we can move on to the next slide in the financing programs. Here we're continuing to build our pipeline and build investments for the organization, and to continue to build our balance sheet and build clean energy deployment. So for CPACE, that pipeline has been impacted by COVID-19, but we do think that we can rebuild that, and our activities this year will focus on that. So our range is built around what we have achieved this year, kind of being on the brighter end, recognizing the setback in that. For the Green Bank Solar PPA, this is reflective of the activity and the pipeline that we have been building through our solar map and our state supported solar projects. The solar map is the municipal assistance program that we kicked off this year. A lot of those projects should be coming to fruition in our next fiscal year. The small business energy advantage is going to continue to grow with the addition of the business energy advantage loans, which we'll be providing a capital facility for with Eversource. Our multifamily pre-development loans, this has been the multifamily sector have really been the most impacted in terms of COVID-19. These are projects where budgets are already tight and where there is discretionary spending. Unfortunately, while they could greatly benefit from our activities, they're called into question. So we need to focus on continuing to build pipeline, and it's very unlikely that many projects will cross the threshold this next fiscal year. The next item that you'll see on here is the Evie pilot offset, or Evie offset pilot program, where we are aggregating charging infrastructure and monetizing the offsets for those. And we're a real leader in this space. It's a fairly complicated program, but it's not complicated for the user. It's very well thought out, and it's a result of a lot of hard work by Matt and his cohorts on our team. And then finally, our strategic investments. Bert, as always, has a lot of things up his sleeve. I know there's some continued support of our anaerobic digester that we funded this year. There's some fuel cell projects in there, as well as some potential shared solar that is in the hopper. And this is just built around, we know that all of that won't cross the threshold and come to fruition this next year, but we know that some of it will. And that's where those targets are coming from. So for the financing programs, we are expecting to finance somewhere between $47.8 and $58.7 million of investment. That will lead to somewhere between 1,200 and 1,316 projects that will deploy between 11 and 19 megawatts of clean energy and avoid between 27,591 and 34,195 million tons of CO2. This is, this is, I think, ambitious, but I think achievable for this next year. Next slide. So talking about how do we get there from a budget perspective. And I first just want to thank the rest of the staff for all the hard work they've done on this, and especially Jane, who has worked nights and weekends to get this done. So thank you. Revenues here are set to increase year on year. And this is a net result. I mean, we are going to see a drop in utility customer assessments coming from Eversource and UI due to COVID-19, but this is going to be offset by an increase in REC sales due to more SHREC systems coming online. Our interest income is going to grow due to the investments that we made this year. And our other income is growing as well due to forecast and fees charged, as well as PPA income coming from the CSCU projects. Operating expenses are due to increase by 1.7 million. This is an increase in personnel-related OpEx of 700,000. This represents merit, which has already been enacted from last year. $24,000 for additional positions added this past year, and $380,000 for new positions, of which $125,000 is contingent upon the battery storage programs being approved. Within incentive programs, non-personnel OpEx is going to be driven by this battery storage program, as well as an asset management platform. This is going to be offset by savings due to bond issuance costs year on year. And in terms of financing programs, non-personnel OpEx growth is driven by our marketing, which is an awareness campaign and what we need to do to continue to rebuild that pipeline. Contractor engagement, we have felt as a marketing team for a while that we need to be more proactive and build stronger relationships, not just with contractors, but across the board. We're really starting our focus on contractor engagement, so some of that marketing expenses there. The rest of it is around growing our solar municipal assistance program. And then the final piece is related to our move of our offices. As you guys are aware, we have a session later to talk about our proposed move due to our leases being up at the end of this fiscal year, or I'm sorry, the end of this calendar year. In terms of program incentives and grants year on year, this increases a net $1.2 million. This is to be expected. We have new RSIP systems coming online, and we have incentives that need to be paid for them. And then in terms of non-operating expenses, we're going to have a decrease year on year of about $500,000. This is due primarily to lower interest expenses and provisions for loan losses, as well as lower forecasts related to our use of the American Recovery and Reinvestment Act funds that we're using for the Smart E special offer. Initially, we had forecast that we would do that interest rate buy down this past fiscal year, but we're actually going to do that in FY21. So I know I've gone through a lot of numbers here, and I know we've vetted this all previously with BNO, but what questions can I answer?
Hey, Eric, this is Eric. I have a, excuse me. Question, and my apologies. I had to move off the computer onto my phone. But when we're going through the targets, in terms of trying to come up with metrics for measuring some of these things. And for example, I guess what I'm asking is, are the targets that are in there that relate to air emissions? Are those the green bank targets, or is that in the context of a consequence of what we're doing in terms of helping the state meet its goals for reducing carbon emissions? I don't know. It sounds a little bit of a type of a semantic question, but my concern is the green bank getting into the business of having air emission targets. Are our targets more geared towards number of charging stations, utilization thereof, or things like that? And then noting that as a consequence of that, there are, this will have an impact on the state's ability to meet its air emission goals.
So these are the impacts of our project. So if we install solar on a roof, what would that do in terms of the avoided emissions from whatever is not going to have to be generated by fossil fuel using our established air quality impact methodology. So what we've done in the past, and we worked with the board on, is to get an approval of the use of the EPA's AVERT tool. We've operationalized that, implemented that, and then we've taken averages by program, which helps us reflect based on the technology mix and what's usually been done. So we can say, okay, for every CPACE project that's done, the air quality impact is usually X. And so if we're expected to do 48 projects, 48 times X is going to be this in terms of air quality impact.
Yep. So these are.
Does that make sense?
Yeah, these are metrics of impact, not as green bank goals for air emission reductions. Is that fair?
Right. It's an estimation of the impact that these activities will have.
Yep. Okay. Great. Thank you.
And Eric, this is Brian, just real quickly, and a clarification on this slide at the bottom. It shouldn't be million metric tons of CO2. It's right in the table up top. It's wrong in the table at the bottom. If we hit that, our world would be in much better shape. But so we'll correct that. But it's really, as we've added the EV offset program, which is, the Green Bank has, working with a number of national automobile manufacturers, EV producers, infrastructure producers, have developed a voluntary standard for carbon offset. So if you're a vehicle, an electric vehicle that's plugging in Washington State, you've got a very clean grid. Therefore, you are offsetting your gasoline consumption versus an EV infrastructure in the southern part of the country, for example. So we've established that voluntary standard for the industry, and the industry is leaning on us to continue to support that standard. So those are offsets that will be sold in the market. So actually in our revenues, we have a carbon offset revenue that will be helping to sell those offsets on behalf of our partners. So that's kind of fundamentally a target to the number of EV rechargers that are being installed across the country. So that one of all the rest is probably the only one that is really target specific. The other ones are just, as Eric is saying, a translation of, if we get solar in the ground, this is the equivalent of that avoidance in a year. Just to further elaborate on that.
Yeah, great. Thank you.
This is Lonnie. Are there any other questions?
Yeah, sorry, Lonnie. It's Steve Meyer. Just a couple questions. So I certainly think stretch goals are important. particularly given the environmental and social benefits of the activities of the Green Bank. But I was wondering, how realistic are these goals given the current situation, and what are the underlying assumptions around the coronavirus in terms of the potential for a second wave in the fall, whether there's going to be availability and feasibility of a vaccination later in 2020 or early 2021? What do we think the pace of the economic recovery will be, and specifically, what do we think the impact will be on residents in Connecticut? Given that pace of economic recovery, I think there's just so many questions around this. I was just curious as to what the assumptions are that underlie this budget.
I mean, I think we recognize that we're in a tough environment, and I think the lower end of this range really represents more of the Nike swoosh type of recovery economically, and a longer recovery. And then the best case scenario is much more of a V-shaped type of recovery. I think that they're feasible. Obviously, we will keep monitoring this throughout the year, and if we need to update things based off of activity, we will come back to BNO and to the board as we usually do in January. As I said previously on the incentive program, so with Smarty and RSIP, a lot of this is dependent on people letting contractors into their homes to do work, and their comfort level around that. We're hopeful. We're seeing some promising signs of increased solar applications, increased activity. Now these need to be installed. So we'll see where that gets us.
Okay, thank you.
Steve, this is Lonnie, and I've not been on the board all that long, but this team does have a real track record for giving you a heads up along the way if adjustments need to be revisited. So so they don't keep us in the dark, which is why they're the Green Bank.
Thanks for that, Lonnie. It's just when I'm on the phone with corporate corporate counterparties or investors and companies that we invest in, we're asking the same questions. What are your assumptions? Because, and again, none of us have a crystal ball, and everything is very fluid. And I recognize that. I was just curious as to what was built in terms of the underlying economic forecast. But I appreciate these are challenging times. There's a lot of moving parts. And I also appreciate that we will be updated along the way as things kind of fold out. Thank you.
Thank you. Are there any other questions?
Thank you.
Oh, hearing no other questions, do I hear a motion to approve item number 5, which is the proposed fiscal year 2021 targets, budget, and investments?
This is John Harity. As chair of the committee, I move the resolution.
Do I hear a second?
Second, this is Binu Chandy.
Oh, thank you, Binu. All in favor?
Aye.
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 All, and anyone opposed? Okay. That item passes. So we're moving on to item number 6, which is proposed revisions to the comprehensive plan. And I think Brian Garcia, you're going to do this presentation.
Great, excellent. Thank you, Madam Chair. So typically we look at, in the July board meeting, going back to the comprehensive plan and making updates to it. We just thought we can work through it at this meeting. So with your materials, you got a red line document of our comprehensive plan. This is required by statute. So the statute says that the Green Bank shall have a comprehensive plan to support its mission, and that's why the budget supports all of that. This is the goals, the objectives, the mission, the vision, all those sorts of things. Last year was a heavy lift because this was the kind of the reimagination of the Green Bank, a Green Bank 2.0, if you will, around this theme of green bonds us. So not only are we looking towards a future where bonds become a larger part of how we raise revenues to support an increase in the deployment of clean energy, but that green, the environment, bonds us. It brings people together. So we are working towards an environment where we believe, given the environmental justice issues we're seeing in our society, social justice issues, that environmental deploying clean energy can help improve our lives. So that's kind of the foundational principles of the comprehensive plan. But some of the changes that you see in the red line document, so we added the target that the board just reviewed and approved into that plan, including the challenges resulted from COVID-19, why the ranges. We included various cleanups, and some of the footnotes, some of the links. The board's now approved of changes in the bylaws, so we'll change those links, numerical updates, program alignment with operations. In last year's plan, we had the Smarty loan in the financing programs business. We moved it this year to the incentive programs business because we're providing interest rate buy downs through the use of ARA funds. And then the Green Bank's balance sheet serves as a second loss, as Bert was mentioning before, to supporting local community banks and credit unions lending in the space. So we just made some alignments there that fit with how we manage our business units. We included the GHG emission reductions in the targets that we were talking about, consistent with our mission statement to confront climate change and that national Evie carbon offset initiative. So we included some of that language there. And then we also included a continuation of our battery storage efforts. You might recall last year and prior years, we had discussed it as contingent on the approval of the Electric Efficiency Partner Program under that docket. Looking ahead, our hope is that through the Equitable Modern Grid docket, we will achieve support to include battery storage with residential solar. And then we included the green bond framework that the board approved at the March board meeting into the comprehensive plan to help readers understand that we've got an underlying foundation for how we measure impact, and that we are looking for independent certification and verification as part of our process to issue green bonds. So those are the things that were in red line that we included within the package, the board mailing, and really, I don't want to say non-substantive, but they're just important updates and inclusions as we continue to update that comprehensive plan. Happy to take any questions, comments.
Okay, this is Lonnie. I'm not hearing any questions. Do I hear a motion to approve the revision of the comprehensive plan?
This is Binu Chandi.
Brenda,
I can
motion
move
to
it.
approve.
Okay, Binu, motion.
This is Brenda, I'll second.
Brenda
This is
seconds.
Brenda, I'll second.
Excellent, thank you. All in favor?
Aye.
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 Opposed? Opposed? Okay, approved. Moving on to item number 7. This item deals with CPACE. So the Green Bank is charged by statute to be the administrator of the CPACE program, and so three changes are being proposed to the guidelines, and I think Mackie Dykes is going to present. Hi, Mackie.
Yeah. Hi. Good morning. As Carolyn Reed said, this is Mackie Dykes, Vice President of Financing Programs. One of those programs is CPACE, Commercial Property Assessed Clean Energy, which, as was just stated, we are the statutorily charged program administrator of. And one of our key duties is to develop the guidelines for the program, which you can essentially think of these as like the regulations for the program to implement the framework that the statute creates. So this was, one of the first tasks we took on back in 2012 when the law passed. We've had guidelines in place since then, but we regularly update them as we learn more about the market, as the market evolves, and as we, catch issues or unintentional consequences of some earlier decisions that were made in terms of the drafting. So this is, I think it's actually the seventh, this would be the seventh set of guidelines that we've put out. And this includes 3 substantive revisions, and then there's some minor ones which are laid out here. I'll spend some time on the 3 major ones. So the first is to, it seems so simple when you look at the actual change, which, right now, one of the key things we do is determine whether a project or a property is eligible for C-PACE financing. The statute says that a property that contains a property with less than 5 residential dwellings is not eligible. So essentially, multifamily building with 5 or more units is eligible, but anything with less than that is not, or a single family home is not. This is not an R-PACE program. Very clear about that. The way we wrote the language was to say that the property cannot contain a residential dwelling, which we didn't have any problems with till we've encountered some unique circumstances that language disqualifies. So we're proposing to say it cannot be a residential dwelling. What does that distinction open up? So we're looking at a property that has a multi-unit, multifamily property on it. So it's got more than 5 units it actually has more than one of these buildings on the tax parcel. But by quirk, it also has multiple single-family homes. All of these are owned by the same entity and they're rented out. And they want to put solar on the multifamily building with more than 5 units. But our existing language, which says cannot contain a residential dwelling, disqualifies this entire parcel. We think from a policy perspective, PACE, in this case, PACE it would meet its goal by getting solar on this multifamily building. So we're putting this change forward. Also, this could be read as disqualifying mixed use properties that have less than 4 or less than 5 residential units in them. So let's say you've got a 2-story building, bottom floor is a commercial space, and then you've got 2 apartments above it. We think as long as more than 50% of the square footage of that building is primarily for commercial use, then that should qualify for C-PACE. But under the old language, which says cannot contain a residential dwelling, it would disqualify because those 2 units. However, the new language would let it in. So that was sort of the unintended consequence, was those 2 types of properties that we were disqualifying that would now be allowable under the new language. The second is our look-back project eligibility. Currently, we allow any measures that have been completed within a year of the Green Bank approving your C-PACE financing to be included in that financing package. However, as we start to learn about more complex projects that can take much longer than a year to implement, we realize that this could have the effect of essentially splitting projects in half in terms of what's eligible and what's not. So you could have a multi-measure project, half of which of the measures completed over a year ago, but the later ones are still in the process of finishing up, which then if they then come for approval, and some of those were done within a year and some over a year, it all wouldn't be eligible. So we're changing it from individual measure eligibility had to be completed in the last year to the overall project had to be completed in the last year. And then finally, we are looking to change the technical review process for third-party PPAs. So I think as some of you are aware, we have the CPACE, we have a requirement that the energy savings from a project must exceed the cost. So an energy audit or a feasibility study is required to estimate the savings so we can compare them to the cost to make sure that's the case. And then we require an independent review of that, of those estimates, just to add an extra layer of oversight onto that. However, for third-party PPAs, we're proposing that instead of requiring that third-party review, we would allow the third-party owner to self-certify that the SIR criteria is met. And there are a few reasons why we're recommending this. One, unlike a typical CPACE project where the project performance risk is completely on the building owner, because in that case, the building owner, it's essentially debt. The building owner takes on the debt obligation to buy the quote unquote buy the project, and they're on the hook to repay the debt whether that project performs or not. So if their solar goes down because the installer did a bad job, the installer has walked away from it, the building owner still has to pay their CPACE lender back no matter what. However, in the case of a PPA, that risk is shifted to the capital provider, essentially, to the third-party owner, because the building owner only pays for the electricity that's produced. So we don't think that the additional layer of oversight that's primarily for the protection of the building owner is necessary. It's not worth the cost of it in the case of a PPA. Second, the strength of the SIR calculation is much simpler with a PPA. You're looking at the existing utility rate, and then you're comparing it to what the PPA is, and making sure that it's lower and that they're they're going to pay less with the PPA than they would pay otherwise without it. And the third reason is the PACE-backed PPA market is primarily serving nonprofits and unrated commercial credits. We're hearing from capital providers who are looking at these projects that the margins on these are thin, and imposing the cost of a technical review, just in the cases of many of the smaller nonprofit projects, can just make them not workable. So given the first two reasons I went through, we think that third reason it's just not worth essentially opposing the cost for the benefit you get from them. The Green Bank would still we're gonna have a set of requirements for what would be needed in a feasibility study, just to make sure that there is some reasonable amount of technical diligence that's being done. We won't do technical review on those documents. We'll just make sure that the work is done, and then we'll be checking the calculations they make. We'll make sure that they're essentially getting the numbers right, that the numbers they're plugging into the models are backed up by the documentation in the feasibility study, and that escalation rates and everything are within program guidelines. So we'll still be checking it. It'll just be Green Bank staff doing that, and not an engineering review. I think the minor revisions are fairly straightforward. So I won't spend any time on those unless there's any questions about them. So I'll pause there. There was a lot that I just went through. So I'll pause there for any questions or comments.
Mackie, it's Lonnie. I'm just trying to recall exactly, I think it was from the banks, the pushback we tried to get some residential PACE bills through, I think, for several sessions. And the banks they were very concerned about mortgages and all that kind of thing. And I'm just wondering if if the rework that you're doing is going to need legislative approval, because it kind of changes the statute if it, or potentially does.
We don't think that we think it's allowable under the statute. We did. You're exactly right that our pace is a completely different beast, and we want to make sure that we're not even getting close to C-based assessments going on a residential home. You know, a home that a person or family owns, that's their primary dwelling. So in abundance of caution, we are also adding language to the guidelines that says any property with a residential mortgage is not eligible. We don't think that this residential dwelling change we're making would even allow one of those to be eligible, but we came up with some when you think through some scenario, we started talking about land trusts and land leases and things like that, where maybe you could see a scenario. So in an abundance of caution, we just added that residential mortgage language, which would clearly disqualify any case like that.
Okay, great, thanks. Yeah, because I can just see the banking committee getting revved up and ready. So that's very good. Thank you. Any other questions? Okay, Mackie, you want to continue?
Yes, that's it actually. So what would happen is we've got the resolution here. These guidelines must go through a public comment period. So if the board is comfortable with the changes, we'll initiate that public comment period. If there are no, any public comments we get that highlight problems with this, then we would move forward with implementing them after that period. If there are any significant changes that are sort of emerge from that process, then we'll come back to the board for another set of approvals.
Okay, and I hear no more questions. Do I hear a motion to approve item 7, the proposed changes to the guidelines for the CPACE administration? A motion to approve?
This is Brenda, make a motion.
So Binu approves, Binu motions, and Brenda, is that you seconding?
Correct.
Okay, all in favor?
Aye.
Aye.
Opposed? Okay, item 7 is approved. Item 8.
Thank you all.
Thanks, Mackie. Item 8. So that we've been very excited in another COVID delay about the Green Bank launch, and so we've been approved by the Treasurer's Office. Thank you, Steve, and OPM, and I think Brian and Bert are going to do the presentation.
Great. All right. Yeah. So we're excited. The Green Liberty bonds were ready to go to market, as Lonnie was noting there. Both the Office of the Treasurer and the Office of Policy and Management are working towards supportive of the use of the Special Capital Reserve Fund to back the Green Liberty bonds. We're not going to use the master trust indenture. We had talked a little bit about that. We talked about that in March when we had our special meeting to get everything in line and try to time the market for when the market was ready, we would be ready to issue the bonds. So we've decided not to use the MTI, and we can get into some of that. We'll have Bert walk us through some of that. But it's great that the Treasurer's Office and OPM, we're still working through the kind of final details. Some of the documentation that the board will approve today will be submitted on to them to help them do documentation on their end to review and approve the SCARF. But we feel we're all in a good spot with regards to those approvals. The second thing is that S&P has rated the Green Liberty bonds, and because we are using the Special Capital Reserve Fund of the state, this is essentially a bond supported by the state. We get an A rating. I believe there were several bond issuances that the state has recently done that received an A rating. So the Green Liberty bond follows the state, given that we've utilized the SCARF. So that's great. We included that bond rating, S&P bond rating. I think it was appendix. It was in an appendices in our self-sufficiency memo that was included in the board packet. And then lastly, the Treasurer's Office has just been doing an extraordinary job, like managing the bond issuances, like literally within the last month has had nearly $2 billion worth of bond issuances, including $850 million for transportation, $500 million for taxable general obligation bonds, and $400 million for untaxable general obligation bonds. So they've been working really, really hard, the state, which we've been trying to peek in and have conversations because they have to review and approve of our SCARF too. So obviously the priority being the large issuances. They've been great with helping us along the way, allowing us to have conversations to get the SCARF approval. But no, we are excited to be bringing the Green Liberty bonds to market. I think, I really, at this moment, when we go to market next week, what I'm going to really feel proud of is, John Harity, is we had the offsite strategic retreat at Botanico in February of last year. The idea that we're going to bring something to market that individuals can buy, for their grandchildren's college, to save for their college, to put their money out to confront climate change as opposed to waiting for our, democracy to kind of catch up. This is going to be a great offering, and we are really, really excited to bring it to market. But let me turn it to Bert, who will talk a little bit about the structure, and then we've also got some schedules here where we'll show you where we think the serial bonds will end up at. So Bert.
Okay, thank you. And Brian, you can just leave it on that slide for the time being. So as Brian mentioned, we're getting close to the issuance of our first Green Liberty bonds. This is an exciting time for the Green Bank. The approvals we need from the board today are to accommodate the change, as Brian mentioned, of not activating the master trust indenture with this issuance. At the March 25th board meeting, the board approved the arrangements associated with the issuance of the MTI. And in addition to the MTI, the arrangements associated with the issuance of the Shrek Green Liberty Bonds Series 2020 that, as Brian mentioned, we'll soon be going to market with. So those documents that the board approved included an indenture of trust, authorization by the board for the Green Bank to issue the bonds up to $25 million. We're going to be well below that, as will be explained by our underwriters in a short while. To be clear, the bonds are special obligations of the Green Bank. They're payable solely from a pledge of the revenues associated with the sale of Shreks under Tranche 3 with Eversource and United Illuminating. And they do not have the full faith and credit of the state or the Green Bank behind them in accordance with the indenture that we are entering into. Board also approved and adopted findings of self-sufficiency as is required by Connecticut general statutes, which is required whenever the Green Bank wants to use the Special Capital Reserve Fund to further support the bonds and attain a credit rating, agency rating approximating the rating of the state. In fact, we did achieve an A rating, as mentioned by Brian. The state is A plus according to S&P. So we're typically there's a notch below for SCARF supported transactions. And finally, the board authorized the president or any other officer of the Green Bank to execute on behalf of the Green Bank any of the documents needed to issue the bonds, and specifically a bond purchase contract with Ramirez and Company for themselves and Stiefel. Together, they are the underwriters for the bonds. A preliminary official statement, and ultimately a final official statement, some continuing disclosure agreement requirements, as well as some ancillary documents that need to be entered into to issue the bonds. This all being said, there are two material and related changes, as was mentioned by Brian, that require staff to bring the bond issuance back to the board today. First, as Brian mentioned, we're putting the MTI on hold for the time being. And second, as the MTI is not being used at this time, it's appropriate in connection with the approval of the SCARF that the bank provide adequate assurances to the treasurer and OPM that funds will be made available by the Green Bank so that the likelihood of a draw upon the SCARF will be remote. To evidence that assurance, the Green Bank will execute a project support commitment and undertaking, which will commit the Green Bank to provide any funds necessary should the revenues from the SHREC proceeds from Eversource and UI be deficient in any way to cover debt service and trustee fees. This is quite unlikely probabilistically, as was explained in the memos that have been circulated to the board in your package. And so this commitment is of project support is similar to undertakings that the Green Bank has made with two other SCARF-backed transactions that the board has previously approved, Meriden Hydro and the CSCU solar PV transactions for Connecticut state colleges and universities. So to properly approve all of the arrangements for the issuance of the bonds, the board is being asked to approve additional resolutions to accommodate these changes, which Bruce Chudwick of Shipman and Goodwin, our bond counsel for the Green Bank, will explain at this time. Are you there, Bruce?
Yes, I am. Thank you very much, Bert, and thank you, everyone. Good morning to the members of the board and staff. Bert really explained it very nicely and put it all together. Really, these resolutions for you today are to update and do a sort of a bring down of where we were back in March, since there have been some significant changes in the structure of the transaction by not having an MTI and having the project support commitment and undertaking agreement being used in its place, and the updated findings of self-sufficiency, which have been presented to OTT and OPM in consideration of the SCARF. Those have been, that's additional information that the board had not seen back in March. So we thought it was appropriate before going forward with the bond issue to basically come back to you and ask for approval of this new documentation, this new structure, and to ratify what you did back in March in approving up to $25 million of bonds. So, but Bert explained it very well, and I have nothing more to add than that. But if there's any questions on the resolution, I'd be happy to address them.
Okay. Thank you, Bruce. I think what we'll do is, before we take questions and discussion from the members of the board, if Madam Chair, you would permit me, I'd like to ask our underwriters, Ramirez and Company, represented today by Al Quintero and Brad Friedman, to say a few words about the bond issuance process.
Absolutely.
Thank you. Al, Brad.
Hey, Bert, thank you very much. Good morning, everybody. I want to again emphasize what an honor and a privilege it is for us to be leading this transaction. We're very excited. Obviously, it's been a much more interesting ride to date than we expected to get this all done. but we are optimistic. Actually, Brian touched on a bunch of the work that the state's been doing in the market very successfully. Just to take a quick look back at what's happened, of course, back in February, we had a strong market with about 40 billion of issuance. Things really went south during the COVID crisis, where we dropped an issuance down into the 20s, below $20 billion. And now for June, we're looking like we're back at 44.6 billion. That is all good. It means that issuers are back in the market selling not just refinancings, but a variety of obligations, tax-backed, charter schools, universities, colleges. And in particular, that bodes well for a transaction like the green banks, which is a very, very sort of creative and new type of very interesting deal. We want to have a market that's focused on the innovation, and we think we're getting back to that. We're of course focused on the retail aspect, and Stifel and we have been working very hard to make sure that this is a retail success. I do have to say that retail investors remind me a little bit of sparrows in the park. You walk up to them and they all sort of poof, and they fly away, and then they sort of fly back and start partaking again. We're going to be very careful to make sure that as many there's as good participation as possible. And retail is always in these situations something that we want to be, very embracing of. And that's our goal here to of course, maximize retail participation through $1,000 multiples on the bonds. And of course, a very strong marketing outreach, which is to come. The structure is retail friendly, we believe. And I think I will pass it along to my colleague, Brad Friedman, to discuss a little bit what the structure entails.
Thanks, Al. This is Brad Friedman. Hopefully you can hear me okay. The structure, basically, we use projections for SREC generation from the solar fleet to structure bonds in order to maximize bond proceeds for the green bank. And we're using a 15-year structure to match the term of the tranche, 10 years of serials and a term bond in 15 years. And we size these bonds to provide debt service coverage of 1.15 times coverage under a P90 scenario. Using this structure, we're able to generate approximately $16 million for the green bank under current market rates. We've been floating anywhere between 15 and 17 million over the last few weeks when we run with rates. And we believe this structure will appeal to a variety of investors, both retail and institutional, who have different investment goals and different investment needs to get the most out of the SREC sales. I think that's it on the structure, unless you have any questions.
That's fine, Brad. Thanks very much for that overview. With that, Madam Chair, I hand the floor back to you for a motion on these resolutions and any further discussion and questions for Bond Counsel, our financial advisor, Bob Lamb, who is also here online, our underwriters or staff, once the resolutions are on the table. Thank you.
Okay, so why don't we do that? Do I hear a motion to approve these resolutions?
I guess I'm the official motion mover today. It's Binu Chandy.
Are you there, Brenda?
And I'm second. I'm here to second the motion.
So is there any discussion? Because there's a lot involved here. Any discussion? Any questions? Okay, hearing none. All in favor?
Aye.
Aye. Opposed? Okay, well done. Excellent.
Actually, Lonnie, there's one abstention. Steve Meyer.
Steve is okay.
Understood.
Absolutely.
Yeah. thank you very much to the board for that. Thank you. We're moving forward.
Yes, yes. So that still passes, and we totally understand Steve's need to abstain. The next item is and actually Bert talked about this earlier. The Canton Hydro project. It's been delayed because of COVID-19, and so I think Mariana's going to do the presentation.
Correct.
That's right. She's on the line. Thanks, Mariana. You can take it away.
Thank you everybody. Lonnie, this is Mariana Treese here with the Green Bank. This is one of those financing arrangements where the Green Bank's outstanding principal is greater than $1 million. So we have to come back to the board for COVID-related restructuring. By way of background, this is a hydro project, 1 megawatt, where the off-taker of the electricity is going to be the state through DEEP through a virtual net metering contract. The project's been under construction as of about a year ago. It was approved in October of 2018 by the board, and financing closed May of 2019 with a $1.2 million subordinate loan from the Green Bank, along with a $500,000 guarantee, and a $4.7 million loan from the senior lender, which is Provident Bank. Construction progress has been pretty much on schedule, but for COVID, the main reason for COVID delays are because the main provider of equipment, Wasserkraft, which is also the turnkey sort of EPC for this project, is Austrian, and Austrian engineers are required to go on site both for the final assembly, but also as construction progresses. And due to COVID and travel restrictions, they have not been able to be on site since March of this year, which has led to the delays. Therefore, we are requesting the board to approve a restructuring of interest payments during the remaining construction period, basically so that the developer does not have to pay quarterly interest that is due during construction, but rather they can pay that once construction has been completed, which is anticipated before the end of the year. That would mean a deferral and sort of an interest payment of about $50,000 for the Green Bank for the remainder of for what they would have otherwise paid quarterly, but has no NPV impact as they sort of continue to accrue interest on those payments that are due. The second request that has come in from the developer is an increase in $100,000 loan for expenses associated with these delays. And this has to do with longer insurance terms, bookkeeping, legal fees, etc. You could go to the next slide. The Green Bank is requesting the board to approve the increase, but with these conditions that Green Bank advances no more than 50% of approved costs that we can tie directly to COVID delays into an operating account secured by Provident Bank, which is a senior lender, which basically means that there has to be an equal match cash contribution to that same amount from the developer, so that we're sharing sort of the cost and the burden here. We've provided an updated or sort of a revised and original summary of sources versus uses of the capital stack, and the increase, the $100,000 increase in the loan amount can be fully covered by the expected project cash flows, which we expect will allow us to repay the loan within 12 years and with a sort of healthy debt service coverage ratio of greater than 3. So let me stop there and see if there are any questions. Bless you. Okay. Hearing none, the proposed resolutions are with regard to the forbearance on interest payments for the remainder of construction and the increase, $100,000 increase in the loan amount to $1.3 million.
Okay,
So
back to you, Madam Chair. Thank you.
Thank you, Mariana. Do I hear a motion to approve this item, Resolution 9?
This is Brenda. I make a motion to approve.
Aha.
Second, John Harity.
All in favor?
Aye.
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 Opposed? Anybody abstaining? Okay, excellent.
Thank
That's
you.
approved.
Thank you very much.
Thank you.
Lonnie?
Yes.
This is John Harity. I just want to do, just as a point of information or whatever, this dam is in Collinsville, and there's a lot of pedestrian traffic there. It's a very picturesque area, and I would hope that if there is the opportunity to maybe have some signage or something or other that indicates the Green Bank support of the dam, that would be considered, because there are just a lot of people who go through there, and they ought to know about the work that we've done.
That's a great idea. I mean, I think it's great when people can actually see the projects that we've made happen, and you know, they connect those dots, and that's a great idea.
I agree. That's a really good point to make.
This is Binu. I think it's a great idea as well. At DCD, we have a requirement for all of our projects. Our clients are supposed to have a little signboard saying that the state has funded a project. So I think it'd be a great idea if the Green Bank has it for all projects.
Excellent.
That's a great suggestion, and we will take that on board in terms of making sure that our agreements with counterparties include that language.
Excellent. Okay.
Okay, Madam Chair, I'm pleased to move on to the next item.
You are? Okay.
Okay.
Okay, we're going to move on to item number 10, amalgamated bank line of credit. And Bert, you're up.
Okay. All right. Thank you. All right. A year ago, at staff's request, the board approved a working capital revolving credit facility to help with cash management of the Green Bank. That was as a result of an RFP, and the facility is being renewed at this time. And Louise Della Pesca is on the line, and she will present that request for renewal at this time. Louise?
Thank you, Bert. Yep, as Bert says, so coming back to the board for the first time since December 2018 with respect to this line of credit. So following the board's approval back in December 2018, we reached financial close in May of 2019 and began a one-year line of credit with Amalgamated Bank. So this is a rolling forward of that line of credit. It's broadly along similar commercial terms, but I'm going to call out the differences for the upcoming year. The maximum borrowing limit will be $5 million as it was previously, but in this renewal, that $5 million availability will decrease by $300,000 quarterly. We have added I'll skip down to the collateral. We have added a source of collateral for Amalgamated Bank, which is the cash flows associated with our Solar Loan 1 portfolio. So in the previous year, the collateral was the Solar Lease 1 notes. And in order to boost that collateral to allow us to maintain a $5 million line of credit at opening, we've included additional collateral. There will also be a general repayment obligation of the green bank. The debt service coverage ratio remains the same at 2.0, tested at the green bank level, because the borrower here is actually the green bank. The interest rate is going to differ from the previous arrangement, and that's because the way rates have moved, it's just simply no longer applicable on Amalgamated side to offer the interest rate that they were offering previously. The new interest rate will be the prime rate minus 0.8%. So in today's money, that's a 2.45% interest rate. So it's actually cheaper than when we entered into the line of credit last year, but it's just a different mechanism of how the rate is being calculated. The front end fee is the same as well at $20,000, and the unused fee for the line of credit remains the same at 0.2% of whatever is outstanding on an average basis at the quarter end. Whatever has been undrawn. So the unused fee is whatever has been undrawn. And if we could go to the next slide, unless there are any questions, please jump in. So I'll hand back to back to you, Bert, to talk through these.
Thank you, Louise. Very good. So, so there you have the presentation to renew this line of credit and the resolutions for approval. Thank you, Madam Chair.
Thank you. So the takeaway is that it's actually cheaper?
Well, no, it's cheaper than when we started. To be clear, it's 0.65% higher than LIBOR plus a 160 would be today. But yeah, still fair pricing. And when this comes up for renewal next year, we're likely to go back into to the market to see if we can improve upon the pricing at that time. But given everything that is going on in-house right now, we'd appreciate approval of this so that we can devote our energies to many other important items that we have on our plate this time.
Are there any questions?
Yeah, Steve, just a question. So the facility actually decreases $300,000 per quarter. Does the lien on the collateral decrease accordingly?
Yes, it's strictly linked to the outstandings.
Gotcha. Okay, thank you.
You bet.
Thank you. Any additional questions? Okay. Hearing none. Be new. Brenda, get ready. Do I hear a motion to approve item number 10, the adjustments to the amalgamated bank line of credit?
I make the motion. This is Brenda.
Do I hear
second, John Harity.
Okay, excellent. All in favor?
Aye.
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 Opposed? Abstentions? Okay, we've moved item 10. It's approved. Excellent.
Thank you.
Thank you. And now we're going to move on to item 11, and we need to first go into executive session. I think hopefully everybody was on earlier, and the number that we need to utilize was emailed to everybody this morning at about 7:25 by Brian Garcia, and so we're going to ask you now to call that number and exit the GoToMeeting. But then we'll come back to GoToMeeting after we finish the executive session.
Perfect. Thank you for that, Lonnie. So yeah, so before we issue the resolution to go to executive session for real estate negotiations, what I'm going to do is I'm going to mute everybody on the GoToMeeting. I'm going to pause the recording, and board members should call into the conference line. I've already called into it. You can hear it behind me, and we will start the conversation there. So I'll wait for the motion to go into executive session, and then I will pause everything.
Okay.
And I'm sorry, that number it was sent out by email?
Yes. Yes, an email from Brian Garcia this morning.
Gotcha. Okay, I'll find it. Thank you.
Yeah, it's right in the body of the email, not an attachment or anything. It's right there at the top.
This is John Harity. There was a phone number, and then there was it said like conference room, and it had a like a number, so like a 7-digit number. Do we have to put that in as well?
You do. After you call in, John, it will prompt you to enter the conference number. So you'll enter that number and hit pound, and then you'll be brought into the conference.
All right, thanks.
Excellent.
Brian, this is Lonnie again. So the way you're going to do this now is we don't go out of GoToMeeting. You're going to mute us. Brian?
This is Brian Farnan. I mean, another option is not to throw a curveball at you. I mean, you could just pause the recording and kick out callers that you don't.
I think that's what he said he was going to do. We talked earlier, and he wanted us to dial out, but it sounded just now that he wants to just pause us, stop recording. But he also wants us to go onto this other.
There you go. Yeah. So I'm here. Forgive me. I had myself already on mute. So I'm gonna pause GoToMeeting, the recording. I will mute it. So for those who are still hanging out in public session in the online meeting, won't be able to hear our deliberations in executive session that will take place through the conference line. I can hear people already coming into the conference line. So if we can just get a resolution to go to executive session, I'll take those steps.
So I'll make a motion. John Harity.
Meyer, I'll second.
Excellent. Okay, great. I'm going to pause this and open up the conference line. Give me 2 seconds.
This conference will now be recorded.
Okay, do I hear a motion? Do I hear a motion? Executive session. Executive session. All in favor? Aye. Aye.
Aye.
Aye. Aye. And a motion to return to GoToMeeting. So moved, Binu Chandy. Oh, thank you, Binu. We need a second. I second the song. Great. Great. Brenda, we're going to have to find you under that desk because you're valuable. Yeah. So we shall return to GoToMeeting and take up this resolution, number 11.
Great. So does somebody want to move resolution 11?
I make a motion to move it.
Second, John Harity.
All in favor?
Aye.
Aye. Aye. Aye. Do we have enough? Have we returned our quorum?
Yeah, you have.
We do? Okay. So all in favor, aye. Does everybody hear that? Aye.
Aye.
Opposed? Good. Opposed? Okay.
Lonnie,
Yes, go
this
ahead.
is John Harity. I just wanted to note that Eric Schrago did an incredible amount of work on tracking down these properties and working with the landlords. It's been just a big slog right along the way, and he's gotten through and found some great spaces. So I thank him for that work.
Yeah, I thank him as well, and I know how hard he's worked, and he's got data right down to the most infinitesimal numbers. He's really accumulated really important components of these contracts. So excellent. So what we're asking in item 11, of course, obviously, is to allow the staff to continue negotiating. So we're approved. So I see no further business. Does anybody have any new business, or anybody just want to hang out for a couple of hours here and go to meeting? Or
Motion to adjourn.
do I hear a second?
This is Brenda. I second.
Okay. All in favor?
Aye.
Aye. Okay. Everybody, thank you so much. I think this is probably our most important meeting of the year as we deal with the new budget. Now we're going to deal with, obviously, new homes. So thanks to everybody for showing up and staying. Have a great weekend.
Have a great
Take care.
weekend.
Take care.
Bye.
Bye, everyone.